the worst sentiment I have ever seen in my 50 years managing money in any sector at any time. So the bottom line is, I think this is a good time to buy some more, but I think there's a high possibility, so 20, 30, 40%, I don't know, but gold could easily break the last low, and I don't know what it is right now as we're speaking, but easily break the last low and go down to 3,600, easily. And if that happens, then of course the gold stocks go down dramatically.
The global precious metals sector is currently experiencing an unprecedented shift in investor sentiment, leaving many market participants highly uncertain about the immediate future. Navigating these incredibly volatile conditions requires deep industry insight and a solid understanding of historical market cycles. AdrianDay, an asset manager, emphasizes that the current negative sentiment surrounding gold equities is the absolute worst he has ever witnessed in his 50 years of managing money. The bull sentiment index for gold miners has recently collapsed to a mere 7%, even hitting 0 weeks ago. Amidst this extreme market pessimism, he presents a vital prediction. There is a 20 to 40% probability that gold could easily break its previous low and tumble down to $3,600, which would subsequently cause mining stocks to drop dramatically. Consequently, the best strategic approach today is to invest selectively in the largest companies while keeping significant cash reserves prepared for better future entry points. Now, we present the clips from AdrianDay's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
The negative sentiment on gold equities among the broader investment public right now is, and I say this literally, the worst sentiment I have ever seen in my 50 years managing money in any sector at any time. So to illustrate that, you know, they have these bull bear sentiment indices on the gold, on the stock market, on the dollar, the dollar's pretty crowded right now as well. So the dollar's about 80% bullish. The gold miner bull sentiment is about 7% right now, which is, I mean, it rarely gets that low. A normal bull bear sentiment index is 60-40, right? I mean, by its nature, any market at any time has people who like it and people who don't like it. There's people buying, there's people selling. And so you don't normally get that extreme. But one day, 2 weeks ago, we actually had 0 bullish. Now, I joke, well, I wasn't in the sample. They didn't ask me. It's a sample, obviously, but they ask. But I have never seen 0 bullish or 0 bearish.
Even
but
with the run-up?
Never.
Wild.
Never. And this is why I say I'm not in the business of predicting.
Yeah.
If I was in the business of predicting, I'd say, oh, gold's going to do this and you buy today, you buy tomorrow. No. So you've got to look at the individual and their risk reward, their risk reward and their tolerance. Start again. You've got to look at individual investor, what his financial situation and financial obligations in the future are. You've got to look at his risk tolerance. You know, how tolerant is he of risk and volatility? 2 different concepts, of course. But the other thing you've got to look at, which is obvious, is how is he already invested? So if I've got a conservative client, and I don't think this violates any SEC rules, if I've got a conservative global account who opened 3 years ago, and I gave that client a 20% gold stock allocation and I bought 20% in gold, well, today, even after the decline, even after me trimming the stocks, that client's now got 35% in gold. Do I buy more today? Of course not. Yeah. Someone who came in on January and I put some money into the market, but I really didn't want to put it all to work. Yeah. Well, yeah, this is a good time to buy some more. Yeah. So the bottom line is, I think this is a good time to buy some more, but I think there's a high possibility, so 20, 30, 40%, I don't know, but gold could easily break the last low, and I don't know what it is right now as we're speaking, but easily break the last low and go down to 3,600, easily. And if that happens, then of course the gold stocks go down dramatically. So I would invest some today in the biggest and the best, and I would keep some cash on the sidelines, you know, for future better price. The biggest thing would be a decline in central bank buying. on a monthly or quarterly basis.
Yeah, buyers are...
Now, in the first quarter, of course, we saw a huge amount of very high-profile sellers, primarily Turkey, the Gulf states, as well as Poland, Russia. So we saw some very high-profile sellers, but we also saw some buying. And for the first quarter, we had very significant net buying.
Yeah.
The net buying in the first quarter, despite those high-profile sales, was still higher than the quarter before.
Right.
April was up on March. So what would turn me really cautious, I mean very cautious, will be to see 1, 2, 3 quarters of net. Not a high-profile sale like Turkey, but net
a little
sales.
Right? I mean, it's a liquid asset.
Yes.
Yeah.
That would make me very nervous. Know yourself. I can't tell you how many people, when I talk to them, when they're opening an account and I talk to them, oh yeah, I'm fine. I'm a long-term investor. I'm a long-term investor. Oh yeah, I'm fine with volatility. I can stand volatility. Don't worry. Nobody has ever come to me and said, I'm a nervous Nelly.
Yeah.
Nobody. So that's the first thing. Look in the mirror and really know yourself. If you cannot tolerate volatility, you need very low exposure to gold stocks because by their nature, they are volatile, very volatile. Don't think you can get around it by using stop losses because you'll get taken out before the bull market's even begun. The second thing is know what you're investing in. Now that sounds obvious. Who's going to buy something they don't know? Well, everybody, including me.
Yeah.
My biggest mistakes, where I've lost the most amount of money in my career, and thank goodness most of it was before I was managing other people's money, was investing in something which I didn't really know. You know, we're having this interview and at the end you say, hey Adrian, have you looked at this new sort of hydrogen machine that they're building in Montana or something? It's really good. It's only 10 cents. Stocks come down. If you're interested, I'll have the guy call you. And he calls me, oh, well, we're really closed. But if you really want in, I'll get you in. And there's a nice juicy warrant. Oh, yeah, let me do that. Now, that's an extreme case, but it's amazing how many people don't know what they invest in. And the important thing about knowing what you're investing in is you know how to react when there's a problem. I know Franco-Nevada and Agnico, for example. I know them intimately. When Cobre Panama happened and the stock fell 25%, I knew that was an overreaction and I knew it was a good time to buy. When Agnico had the rock thing last week and it went down 5%. Now, of course, today, maybe it doesn't look so good. I should have waited. But, you can put that problem into perspective because you know the company. Now, let's just imagine you didn't know the company at all, but AdrianDay just said Agnico's a great company, so I bought it. Well, oh my gosh, they got a rock problem. It's at their biggest mine. It's at Malartic. Oh my gosh. What do? You panic.
Yeah, exactly.
And so knowing what you invest in is the most important thing.
Understanding individual financial obligations and risk tolerance remains essential before allocating capital to volatile asset classes. Volatility and risk are fundamentally distinct concepts, yet individuals consistently misjudge their emotional tolerance for sharp market fluctuations. For instance, global central bank activity serves as a primary indicator for institutional health, where significant net buying historically provides a firm floor. However, a crucial prediction indicates that witnessing 2 or 3 consecutive quarters of net sales from these central banks would signal a highly dangerous environment, turning the outlook explicitly cautious. Managing these fluctuations requires deep familiarity with the operational realities of individual companies, rather than panicking over temporary operational setbacks or sudden equity drops. Maintaining long-term stability depends entirely on looking in the mirror, knowing personal limits, and avoiding premature stop losses that take investors out before a true bull market begins. Now, let's get back to the interview.
First of all, I think gold has better risk reward. There are plausible scenarios I can imagine where silver would be hurt more and on a longer term basis than gold. So on a risk reward, I think gold is better. But if you're looking purely at potential, then I think silver is a better buy right now. But the thing people forget about, and I'll answer the question, but the silver miners are dependent upon the price of silver. So we'll start with silver. There's 2 really important things about silver, and I'm not going to go into all the everything. But there's two things about silver as an investor, we should really focus on. One is we all know it's more of an industrial metal than is gold. But people seem to think that industrial demand is just forever. No, when the price of something goes up from $10 to $100, what does the end user do? They look for substitutes.
They get creative.
And they get creative and try to use less. And so Chinese solar manufacturers, silver represented 10%. When silver was at $10 or $12, silver represented 10% of the cost input.
Right.
You didn't really care about it. Was it $10? Was it $12? Was it $15? Who cares? You just buy it and use it. When it ran up to 60, 70, 80, 100, then it becomes very, very meaningful. And so what you find today, you can't substitute anything right now, as far as I know. You can't substitute something else for the silver in the solar panel, but you can become more efficient. And so the Chinese manufacturers now, their usage of solar manufacturers, their usage of silver is down about 25%. Meaningful. And you're going to see that in anything and everything. Rick Rule likes to say, I think it's a common phrase in the industry, but the solution to high prices is high prices. And so high prices lead to substitution and to efficiencies in use. And people seem to forget that. They think, well, look at all this industrial demand. That's going to carry on. The other thing about silver, of course, is different from gold, is the retail component of demand. And in January, the gold ETFs were seeing outflows. Right. The silver ETFs were seeing inflows. But when the retail changed, that has an oversized impact on the price of silver. And so it doesn't surprise me that today the silver's gone down more than gold. I think when we get down, I don't know what it is right now, but when we get under 60, 55 to 60, I would think that would be pretty much a low, and I would be looking to be pretty aggressive. But I would always favor in this market, I'm going to favor the equities. Yeah. The other thing about silver, of course, as we all know, is that there are very few pure silver mines in the world. Something like 25% of silver production comes from silver mines. The rest is byproducts. Some's byproducts of gold, but some's byproduct of lead or zinc. And the lead miner in Bolivia doesn't stop mining lead because the price of silver collapsed. It's only 8% of his byproduct credit anyway. So the supply does not respond to changes in the price, right? Because most of it is byproduct. But that flows over to the companies. There are not that many pure silver companies, whether they're silver producers or silver explorers. You look at Pan American, I think the second largest or third largest silver producer in the world. Last year, 20% or less than 20% of his revenue was in silver. Yeah. But it's Pan American silver. This year with the MAG acquisition, it'll be about, depending on price, of course, it'll be about 23%. So still a minority of their revenue comes from silver. But and I love Pan American, by the way, I don't want anyone to think that means I don't like it. But when the silver price moves and people are looking for silver stocks, they will buy Pan American silver.
Right.
Shifting focus to the broader precious metals ecosystem exposes a fascinating divergence between the operational dynamics of gold and silver. Gold currently offers a more stable risk-reward profile under current conditions, but silver holds much higher absolute growth potential for aggressive buyers looking to maximize returns. This dynamic is heavily shaped by industrial demand, particularly within solar manufacturing sectors, where rising resource costs inevitably force companies to pioneer massive conservation efficiencies and reduce metal usage by 25%. Furthermore, structural supply inelasticity complicates the market, because roughly 75% of global silver production emerges merely as a minor byproduct of base metal mining operations, meaning supply cannot easily contract during sharp price downturns. A definitive prediction outlines that when the price drops down under 55 to 60, it will likely signal a major macro low, paving the way for an aggressive accumulation phase. Even prominent entities drawing a minority of revenue from pure silver will experience significant capital inflows when general market momentum inevitably shifts. Staying ahead of these macroeconomic tides requires constant vigilance, disciplined portfolio rebalancing, and choosing high-quality equities over physical assets. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.